Quentin.
Hey, how you doing, Cherry?
Well, welcome to our Truth About Real Estate Investing show, and welcome to my very first podcast host duty show. I hope we will be doing okay. So what's keeping you busy these days?
Um, let's see. I'm buying apartment buildings. We closed on in March. We closed on a 17 unit and a 24 unit. 24 unit was in Kingston. 17 unit was in Belleville. We're closing on 100 units at the end of this month. Next month we're closing on a 20 unit and another 16 unit. So we're buying apartment buildings.
Oh, so
That's
it
keeping me busy.
sounds a little bit busy, but how's the summer? How's been being a baseball dad?
It's been really good. My oldest son got onto the York Bulls baseball team, so we're going to be doing a lot of that in September and October. He has double headers every weekend. My younger son is doing house league baseball, and we were really enjoying that. I did a trip to Machu Picchu, the Inca Trail, with my oldest son. We did a
Oh,
week.
yeah, I saw that.
At the end of June, and then both my sons, we did a whitewater rafting trip at the beginning of August for about 4 days. So we had lots of fun there. So
That's amazing.
yeah, it's been good.
Yeah, I heard baseball is worse than hockey in terms of training schedule and then also competition schedule.
It definitely is a lot. Is a lot of time, but now that he drives, the
Oh, he
older one,
drives.
yes,
Ah.
and so that makes it a lot easier. So he is able to drive himself to practice. My older son works out like every day, so he goes for like 2 or 3 hours, takes the car and goes and works out, comes back, right? So like it just it makes it a lot easier, and then we just show up to the games.
Okay. Yes, that's like I would say 80% of the battle.
Yeah.
Yeah.
Oh yeah, for sure. There was a lot of chauffeuring going on between Laura and myself, just getting the kids to different events and stuff like that. And now with the older one driving, sometimes you can take the younger one, and
Oh, that's amazing.
yeah, it
That's
does
amazing.
helps out quite a bit for sure.
How do you let go? Like, I don't know if I would ever be able to like completely let go. Like drive the car, take the car and not worry about them.
Well, I mean, you still worry about them. The other thing was he's not driving my truck. We bought another car, and we're using this one. We call it the family car.
Oh, okay. Okay.
Right? And it's neither my wife's car or my car.
Yeah.
We have a third vehicle. So, and it's just like a little Hyundai. What is it? I can't remember. It's just like a little Hyundai, and it's great for getting
Sedan,
from A
yeah,
to
yeah,
B,
yeah, yeah.
so it's worked out well.
That's awesome.
Yeah.
That's amazing.
And he's been really good about we make sure that he contributes to the car, so he's paying for his insurance and
Oh, he is.
yeah, and then after the first tank of gas, because that's to get to work and to go to the different places, he's paying for anything additional to that. So we want to make sure that he has some responsibilities too, when it comes to keeping and maintaining the vehicle. Any tickets he's going to pay. So
Oh yeah, for sure.
yeah.
So like going along with that line, I know you have been an educator for many years before you jump into being a real estate investor full time, and you've got a wealth of knowledge to share. And how are you educating your kids? Because your kids are, I mean, my kids are 8 and 7. They're relatively young, maybe 10 years behind your kids. How are you educating them, and how are you developing their financial sense?
It's being open, having conversations. So at dinner time, my wife often says that we talk about finances quite a bit,
Oh yeah.
right? And it is something that I never did when I was a kid, but I'm making sure that we talk about it now. We talk about, prices, we talk about inflation, we talk about just different concepts, real estate, and the Purple Book, right? The Robert Kiyosaki
Oh,
book,
the Purple
right?
Book.
Yeah,
Yes.
we,
Yes.
I would have them listen to that when we did car trips. So
Oh, cool.
I put on the audiobook version when they were younger, and when I took them on long trips, I would just put that on, and then we would talk about concepts. I like definitely encouraging the older one to read books, and making sure that that he, reads the books.
Yeah.
Right. So that's been good. The younger one, he's still, he's interested more in cryptocurrency and NFTs and that sort of thing. So I'm encouraging, I bought one of his NFTs.
Oh, cool.
Right. Yeah. So I was like, are you sure I'll buy it? I don't know.
Yeah.
Right. So I'm encouraging them to experiment
Explore,
and, do that. But yeah, I mean, it's always about sharing and just telling them what I'm doing. Like I'm often saying, look, I've raised this, we're buying this is what I'm doing, right? So I'm pretty open about it so that they understand what I'm doing. They don't understand the details and going into it, but if they are interested in, I'm always happy to share more, right? So
that's really cool. Really cool. I'm trying to make Bruce do these burpees. As they do, as he does burpees, he earns like 10 cents per burpee. And so he's doing a lot of burpees lately. It was by accident that we discovered that Bruce is only 7 years old, so he's like quite young. He doesn't really quite grasp the concept of money. So it was by accident. He loves going to the gym with me. So my trainer offered him 10 cents for burpee because he's always reading the book at a gym.
Right.
And so he started doing burpees. He got so excited about doing burpees because of the money that I realized, hey, like you are actually very motivated by money. I'll just pay you to earn that money. And then a few weeks later, we go to Niagara Falls and we were at this breakfast place, which is totally a tourist trap.
Right.
Anyway, so they charge $5 for a cranberry juice, a glass of cranberry juice, and Bruce wanted the cranberry juice, and I said that's fine. So you have to pay for it. It's $5, and then I said, how many burpees do you have to do? 500 burpees. He's like linking the two and he's regretting it. So he's linking the two. I know it's not a direct kind of science to match the two. Nobody is going to pay him to do burpees ever. But it's kind of like introducing that concept. I think introducing it and talking about what you do, I think leading by example is also extremely, to me, it's extremely important. I'm trying to live up to that standard.
Yeah, for sure. And I mean, like they really need to know that like there is different ways to earn like money as well too, right? So that's time per hour, right? And that's definitely how everybody starts off, right? And then there's other ways like investing your funds in order to have your money make money for you too, right? And that comes later on, but that's great. That's definitely a fundamental concept for them to learn. So that's pretty cool. I like that.
Paying for his burpees. So you mentioned that you have been so busy purchasing, closing properties, and then scouting properties to buy as well. Can you share with us how, where or how you're investing and finding these deals? Because majority of the people are complaining like there's no deals out there. Maybe there are more deals now after the interest rate has gone up so much, but before people were complaining like I can't find these deals.
Well, luckily I have a book on that topic called The Finding Properties Toolbox.
That's awesome.
And it goes into a lot more detail, but there are a lot of different approaches to being able to find properties, particularly multifamily properties. And it's more about the relationships that you have than it is about the marketing strategies. There are a lot of, I get, every week I get mail from realtors, from people who want to buy directly, who's purchased a list and are mailing apartment building owners directly. I get phone calls from brokers asking me whether I want to sell my buildings, right? So there's that approach to doing it. Another approach is talking to the people who are interacting daily with apartment buildings. So talking to property managers and saying, hey, listen, especially because I'm not a realtor. So I can say, look, property manager, if you have, of one of your clients that are looking to sell, I will pay you a $5,000 referral fee if I close on the building. And I'm happy to do. I've paid a property manager $20,000 to close on a building, and then I refinanced all my money out of the building 2 years later. So
Oh, that's
like,
awesome. That's
but
awesome.
but I mean, like having those, just because I know I can do that, yeah, I do that. You can talk to trades and be able to find that. The other thing is that develop relationships with realtors and brokers who that's what they do daily. That's the relationships that they have are with building owners. That's where you're probably going to get your biggest result, is developing good relationships with people who are actually in the trenches day to day, dealing with the relationships that they've built over the last 10, 15, 20 years to connect with other building owners. And now they're connecting, what they're trying to do is connect the buyer and the seller together themselves. That's who you, so if you can build those relationships, those are 3 different strategies that you can use to, be able to pick up multifamily buildings. And if you want more, go pick up a book.
So, what's the percentage of your property purchase through the strategies that you mentioned, or are they also on MLS? How many are through your relationships or your network, and how many are really through the public MLS? I saw this listing. Like the rumor or the story that I've always been told is that when you buy multifamily, it's never on MLS. Those are like probably the last ones that you would look at.
I don't think I've bought apartment building off the MLS.
At all?
I don't think so. Not that I can think of off the top of my head. No. The 25 plus buildings, none of them have been on the MLS.
Wow.
Not that I can think of. Usually it's relationships. Yeah. I'm just trying to think if there was one on the MLS or not. And
no, but that already gave me the audience, the percentage that if you want to get into the game, you're not just relying on MLS. You have to develop these relationships.
I mean, and that is actually why people tend to want to partner with me, is because I've developed all those relationships and, I've been able to have the deals that make sense. And I have developed partners who get deals as well. And like all of that stuff is things that have been developed over the years, right?
Yeah.
I often make jokes sometimes that MLS is where good deals go to die, right? Like, especially in the apartment building space. Yeah. But I mean, if I was to list a property, I would probably want to list it on the MLS, right? Yeah. Because I know that I would probably be getting the most I could for them. Now, if you developed a relationship with a broker and they're able to give you the price that you want, and it makes the most sense because based on cap rate and net operating income, you get the price that you want, then why even go to the MLS at the same time, right? Yeah. It doesn't make sense. So I don't know. There's a lot of pros and cons, I guess, but when it comes to buying properties, it's always been based on relationships. Relationships that have been developed, for sure.
Like, I have to say, early on in my career, I was very focused and very narrow-minded, and I would just hide myself in the home office and cranking numbers and crunching tax returns and doing all these things. And it wasn't until recently, like, just to be fair, I am still at heart an introvert. People don't call me an introvert, but I am at heart very much an introvert. To push yourself out there, to do the network and make yourself known is not my own nature. Are you an introvert or extrovert? You are?
Oh yeah, I'm a big introvert.
No way.
Yeah. Well, yeah. Sometimes you can see me at parties, and I'm just sitting there looking. I do push myself to be able to go out and talk to people. Most people would call me an extrovert, but I'm not. Like, I am. It's just not. I like to sit and think. Yeah. Honestly, I would rather be going for a walk by myself than I would be in a party with a bunch of people. Like, I would rather be hiking or, camping, and I'm good with being by myself. It's funny, I was at a retreat once, and people were all talking about like what they would like to do, and I was like, well, I'd just like to be on an island by myself for a week. Right? And
I don't think I'm at that extreme yet.
Well, I just sometimes when I was in university, I did tree planting. right? And tree planting enabled me to pay for university, and I got paid per tree. But I would be working by myself for 8 hours, just like hard labor, and that was fine with me. I was good.
Wow.
You know,
Wow.
you crave, at that point, you start to crave being social with people,
Yep.
right? Because you're often by yourself, but I was okay with it, right? Like, you know, everybody's different. You got to kind of, you do have to talk to people. You do have to do events and,
Yeah.
you know, but it's about pushing yourself, right? I'm a very goal oriented person. You know, I like to do traveling. I like, you know, I like to do and push myself to do new things, and that makes me get out of my comfort zone. And the only way to grow is to get out of your comfort
Oh,
zone,
absolutely.
right?
I agree.
If I only did, sometimes I tell people, if you want to change, especially what you're doing, add a 0 to every deal that you do going forward, right? And all of a sudden you move from a $1 million deal to a $10 million deal, totally different, right? And
Yeah.
that's going to push you out of your comfort zone, right?
It's kind of the 10x mentality.
Yeah, absolutely.
Yeah.
And it's not for everyone, right? You have to decide for yourself if that's for you. But if you want to grow, you need to do something different. You can't grow by doing the same thing over and over again. You need to grow by doing something different. And then once you find something that you're happy with, then you just, you know, that's, you can continue to a point.
Yep.
But what gets you to one place is not going to get you to, you know, a different place. You have to change what you're doing. Right?
Absolutely. So speaking of that, changes and going into different markets and buying multifamily, because we talked about earlier on between us that you didn't start buying multifamily unit,
No.
like 100 unit in one town right from the get-go. There was a
Right.
journey from the beginning to now, and you also quit your job and focus on this full-time. I want to revisit that story a little bit because I think to our listener here, there is a lot to learn from you, because a lot of us are attracted to real estate because they want financial freedom and dreaming one day that, hey, maybe one day I can quit my job with the real estate portfolio. How did that happen to you?
Well, I mean, what ended up happening was that I built a small portfolio of properties, mostly single family homes and duplexes. And I ended up with about $5,000 a month in cash flow that had come from my portfolio. This was back in 2013. And 2012, I'd been banking that money aside. And then 2013, I needed to make that decision whether to continue or not. Now, when I quit my job, I really only had that one source of income. I was running the Durham Real Estate Investor Club, and that gave a little bit of income, but it wasn't as much as my portfolio was. And then when I quit my job, I added another form of income, which was flipping properties, which allowed me to gain. And all I was doing was the same buy, fix, refinance strategy that I was doing before. But instead of refinancing, I was just selling them off. I always have a backup strategy whenever I did those projects. I always have 2 or 3 different ways to exit a property, either refinance and hold, or refinance and partner with somebody, or sell, which is what I was doing at that time. And I was just selling them off. And what was useful about that, and I don't think a lot of people realize this, is when they quit their job, you're not going to get financing anymore.
Yes.
It becomes much more difficult to do that. Now, you could go to B lenders. There are different ways to go about doing it, but it becomes a lot more challenging. So what I ended up doing, once I realized that wasn't going to be how I continued to grow unless I partnered with other people who would qualify, and I've done that before, but what I ended up doing was moving to the apartment building space, where it wasn't based on my qualification. It was mostly based on the building qualification, right? And that allowed me to scale and continue to grow. And then as I refinanced those assets, I was able to recapture some of the equity that I could reinvest into other projects and to do what I needed to do with that. So I think that 1 to 4 unit properties are great for people to start to create that base layer of financial freedom. And then once they take that they get to a point where they say, okay, now I'm going to leave my job, or I've created this great base of income. Now it's time to think about moving to apartment buildings for sure. And maybe even just before you do that, to move to apartment buildings, because I think that is where you actually create wealth. You create net worth. And you're not creating, I think sometimes the mistake is that people think that apartment buildings, they're not a great cash flow generator. I think that the thing is that you have to change your thinking into how that cash flow comes to you. Because in an apartment building, you may be reinvesting all of your cash flow into the asset, but in year 3 or year 4 or year 5, you refinance all of your money out, right? And then in year 6, you do it again.
Yeah.
Right. And the challenge is to make sure that you're not extracting too much equity so that the capital gains you've extracted so much equity that you can't pay the capital gains if you decide to sell the asset, right? So that's a problem, but that's not a problem with 1 to 4 unit properties, right? And so it's a different model, and I think that as you grow from in what you're doing, depending on where you're at, that's when you need to decide on what you're switching to, right? And I have a great chart where I show, people start off in the build phase and then they move into the growth phase, right? And when they move from the build phase, they have high leverage, right? Because everybody starts off with high leverage. And then as you're building, your leverage starts to decrease and your cash flow starts to increase. And as you get further along in your real estate investing career, you end up with, very low leverage, higher cash flow, but that takes time to be able to get to that point. The issue with real estate is that you can be equity rich and cash flow poor.
Yeah.
Right? And so
lots of clients are like that, showing negative every single year.
Yeah. And the challenge is, okay, well then how can I leverage those 1 to 4 unit properties in order to access some of that equity, and maybe you lend it out. Maybe you do some other strategy in order to create cash flow from that. But that is really a problem with 1 to 4 unit properties. In the multifamily space, it's based on net operating income. And because I can add, increase my rents, I can increase the value of the building. Thus, I can refinance the asset a lot easier and then recapture that equity and put it to work again into more assets.
So what's the typical loan to value when you refinance, when it comes down to the multifamily space?
It just depends on the debt coverage ratio, and it depends. So let's say you're going to CMHC financing, you're probably at a 1.2 debt coverage ratio, but that could mean an 85% loan to value depending on the asset. And we just did, was it a 17 unit? Yeah, the 17 unit was a 40-year amortization, 85% loan to value.
Wow.
But the debt coverage ratio is 1.2 on the asset. Makes sense.
Yeah, if you can get 40-year AM, yeah, that's amazing.
Right, and that's in the multifamily space, right?
Yep.
So and it's very different. But could I qualify for a car loan? This makes no sense. Yeah. But this is the banking system, right? Instead of taking a loan, I'll just pay for it in cash. Yeah. Right, and then that's fine. It's just a different way of doing it, unfortunately, right? But because I don't have a T4 income in the same way, I have to make sure that my corporate books are in order. I can show what my corporations are making, but because I don't take it personally, because I don't need it, right? I may not be able to even. It's such a weird situation, right?
Yeah, that's how our banking system works.
That's right. So, in Canada.
Yes. So, okay, now that you mentioned in Canada, so right. I've seen somewhere that you've invested in the States.
Yes. Oh, yeah.
Yeah, how are those investments coming along?
So I have, I've got properties in Tampa. And the Tampa properties I bought in 2018. And because I couldn't get financing, I had to purchase them cash, right? I couldn't get financing on them. And then I got... a foreign a foreign what do you call it? Like a foreign buyer's loan or whatever.
Yeah.
And it was like a 7% interest rate at 65% loan to value, which was a real pain. But since that time, just earlier this year, I actually was able to get a loan with a financial institution that had in Canada that had an office in Florida.
Oh.
And so what that enabled me to do is get a 75% LTV at like a rate that made sense, which was like 4%.
Yeah.
The properties in Tampa had actually doubled in value since I had purchased them.
Yeah.
And, now it still cash flows about $2,000 per month on those assets. And, and I've got different, I'm involved in different projects down in the US, but I see my stuff in the US as a hedge against the Canadian economy. It gives me the opportunity to get paid in US dollars, and that's really the main reason for investing in the US. And it's important to from a tax perspective to avoid double taxation, right? Because if you're not structured properly in the US, it could really mess you up. And I find that a lot of advice out there is bad advice because it's old advice that doesn't work anymore. Like use LLCs and things like that, right? Which just don't work anymore, right?
It's not just that. Like we had in our practice, I mean, this is the truth about real estate investment show, but I can't help to talk about some taxes. We've helped a few of our clients doing some structuring lately with their US purchases. And we found that with our experience, even with the great limited partnership structure, we see some crazy number of taxes. The combined between the Canadian and the US side is crazy, even with the proper tax structure. And it's almost like a cost of doing business outside of Canada that people often don't account for. So that's the part that I always wanted to do a sort of a presentation on eventually, one day. I'm not ready. I'm not there yet. So
that would be a great presentation, I'm sure.
Yeah. Absolutely. So, a lot of investors and you in different stage in their journey. And I mean, Erwin and I never really invested in, never made a leap to invest in I guess in apartment building. We wanted to. Every time like I went to the multifamily conference, I see all these people taking all these massive action. I talked to Sarah. I see that everyone's doing all these massive action. The only holdback I have is like I have my own accounting business that I do have to take care of, and my husband Erwin has his own real estate team that he has to take care of. We have businesses, and how much of the involvement, the day-to-day involvement, how much time do you need to do this thing?
So that's a trick question.
I'm not trying to trick you, but
no. But it depends on how you answer it. So what I would probably say to you is then you partner with somebody who does the day-to-day work. And you don't take on the amount of work that's required in order to do this and build the relationships and do all those different things. So you don't have to be the person that oftentimes I have conversations with business owners and usually professionals like doctors, dentists. I'll talk to just different people who are busy. And instead of you don't have to be the person who is the operator and do the day-to-day to benefit from apartment buildings. You can be a partner and it's okay.
Okay, so how does the number work? Tell me. Pretend that I am the crazy rich Asians. I'm not. But pretend that I am. But how does the number work? Like if I were to put in like $200,000 and invest it in one of your projects, how does it work?
Well, I can't really present something like that on a show like this, but like in general, what happens is that you would take your your funds and you would own an actual piece of the building. You're actually an equity owner in the project. You are not, this is not like a fund, right? Like you're actually an equity owner. So that is shares that are equity positions in the building.
Okay.
But what happens is that within that structure, there are people who are, more active, and those people will have a higher percentage, but they end up doing the business plan. So they're working on, the day-to-day operations of the building. They're also doing the, making sure that the property is going to be able to be refinanced and pull all the funds out. So usually what happens in year 3 to 5, we're looking to refinance the building and make sure that our partners are able to get back the funds that they invested, but they still own the equity share of the building.
Ah, okay.
Right? And so if you think about that from a return perspective, that in 3 to 5 years, that's very lucrative.
Yeah.
Right? And nobody can promise anything, but I've been doing this since 2009, and I work with people that I like and that like me. And I think you don't have to be the person who is in the day-to-day. Now, if you wanted to be the person who is, and this is the other side, if you want to be the person that is going to be in the day-to-day, there are lots of great people that have courses and that, that you can learn on, how to do underwriting on a multifamily building to make sure that you're able to carry out a business plan, right? You need to spend time and effort into learning that business. You need to be able to develop the relationships and go out. Like, I'm often, like, maybe once a week at least going out for lunch or meeting somebody. This morning I was meeting, I'm always meeting people and building my relationships. And that's something that you're going to have to be able to do. If you're a busy business owner, you don't have time to do that, right? So you have to keep in mind that there are a lot of things in the background that you need to do as well. You could just buy a building off the MLS. That's definitely something that you could do, but that doesn't mean that you're going to be cash flow positive when you're doing that. And it doesn't mean that you're going to be in the position to refinance in 3 years, but it could mean that you still own that asset, right? So it just depends on, like, how you want to go about doing this. Anybody can buy real estate. It doesn't, you don't have to be, you don't have a PhD to do that. The problem is that, buying the wrong asset is going to be a lot more expensive than just partnering with somebody and doing the right thing, right?
Yeah, absolutely.
Because, like, apartment buildings, like, if you end up with an asset that's losing money every month, and then you have to put in $100,000 or $200,000 for renovations, and then you have to, pay somebody to leave, and then you have the LTB issues that come up, you can be out like hundreds of thousands of dollars, which is
for sure
very different than, dealing with 1 to 4 unit space. And that's often why I say start off there, right?
Yeah.
But I often have, like, we are usually, working with people who are working in the 1 to 4 unit space, don't want to get into the commercial space, but know that that's where they want to go. So when they sell an asset, or, they may work with us, right? So there's just different ways of doing it. Like, yes, you can definitely do it. How much time is really based on the amount you want to dedicate to it, right? That's the success you'll have, right? If you want to be a great multifamily investor, expect to spend, 20 to 30 hours just like every week working on that business, to a point where at some point you'll know what you need to do, and then you'll be spending a lot less time doing it. Right? Just like any business.
Absolutely, 100%.
Right?
Like, when we go to events, we often get pumped up and think, oh, it's super easy. Like, tomorrow, the day after the event, I would hear or see my clients saying, like, I'm doing this, my goal is this big, and I'm, like, happy for them. It's just that at the same time, I'm looking at my own personal situation. Like, can I just quit my accounting job and just do this full time? And that's not something that I can, at this point, I want to do. And so that's why I'm like, I need a realistic picture in terms of how much time commitment you need. I guess with any business, it's the same.
It's the same with your like, how long did it take you to get to where you are?
A long time. 8 years, 10 years, 8 years.
Yeah, and same with me. It's taken me that long to be able to build my portfolio to the size that it is, and develop all the relationships and the business partnerships and all of that got me to this place. So, yes, can anybody do it? Yes, anybody can open an accounting practice. Can you be a successful accountant with a successful practice? That's very different.
Yeah, absolutely. Right? I agree, 100%.
Yeah.
Now, speaking of all these investments, where do you think the interest rate is gonna go?
Oh.
The $1 million question.
All right. First of all, I hate that question because I get it asked all the time.
Oh.
But I
have to ask.
I know, but the thing is that interest rates are just an expense. Let's not people get all caught up with what's happening in the last 30 days and lose sight of what happens in the next 10 years from today. Because if you think about interest rates in the fact that, okay, interest rates have gone up, you're probably thinking, because the 1 to 4 unit market has lost 25% in the last 6 months or whatever it is, you're losing sight the fact that in the last 10 years that that same asset would have probably tripled in price.
Yep.
Is it so? Let's start to focus on whether the property cash flows. It makes sense. It's cash flow positive, and you're able to carry that asset based on, let's say, 10-year rates. Can you carry that asset based on 10-year rates? And that way you're stress testing whatever you're buying, and you're able to hold that asset for the long term. Because if you're able to hold that property, and everybody out there, I want you to think about, if you bought whatever property you lived in 10 years ago, what is it worth now? Right?
Yeah.
It's probably worth a lot more.
Yeah.
Right? Especially if you're in a market that makes sense. We have population that's coming to that area. We have different sorts of employment. We see governments that are investing into the infrastructure in the area. We see all of those good things that make the economics of an area good. Right? If we're doing that, that's what we should focus on, because the interest rate is just an expense. It's just like property management. It's just like property tax. It's all it is an expense. Let's not get carried away is what I want to tell people. Stop thinking about what's happened in the last 30 days and start thinking about what's going to happen in the next 10 years. And then make sure that you're buying properties that are cash flow positive. I've always said that. If you buy a property that's cash flow positive and your plan is to hold it for 10 years, and you've stress tested the asset so that you know that you're going to be able to withstand, rates that go up, then what does it matter what interest rates do?
So that's such a tricky answer as well. The reason is because then it leads to a lot of the questions that maybe I don't get, but a lot of our clients would be asking those questions. How do you find these cash flowing properties? Because it seems like it's disappearing. Like I think Durham and Hamilton is where I invest, and I know you invest in Durham heavily, at least in that 1 to 4 unit space. So how do you find the properties that would still, at least, let's not go to cash flow positive, let's just go into like cash flow neutral. How do you at least find that properties that would be able to give you enough rent to support everything?
Well, let's say prices decrease 20 to 25%.
Yes.
All of a sudden, you're going to see assets that make more sense that didn't make sense before.
Yeah.
The trick is to stop being fearful and start being greedy, because this is what everybody else is. They're being fearful. Yeah. Aside from that, what ends up happening over time is that you move out from a market and you move further out, but you want to make sure that the economic fundamentals are there with whatever market that you're interested in. So maybe instead of being in 10 years ago, I could have bought a property in Pickering and it would have been cash flow positive. I'm not going to buy a property in Pickering that's cash flow positive today, right? So I'm going out to maybe Bowmanville to be able to buy a similar asset. Now I'm still in the Durham region, but I'm going further east, right? Maybe I'm in Peterborough, maybe I'm in Kingston, maybe I'm in Belleville, right? And I'm looking at different markets. As long as all the fundamentals are there for the market and you see the long-term macroeconomics are there, and then the fundamentals are there, that helps you to make a decision on where you're going. I may be called the Durham Real Estate Group, but we have people from all over the place that come, because it's not about that. It's about buying cash flowing assets.
Yeah.
So maybe what it is like people need to start thinking about a different area. Like if the area doesn't make sense right now, move to a different area that does. Right? Don't get pigeonholed.
Well, like we work with a lot of clients who buy pre-construction homes, and they feel comfortable because they know, and it's like less to maintain because it's only a pre-construction condo per se, and so there's only 800 square feet to maintain. There's only so many appliances in there, and so a lot of these people are unable to get financing. They are running into different challenges, and but they see the capital gain appreciation because they tie up your money for a number of years, and therefore there is that I guess not forced appreciation, but the market has gone up over time, and then they see appreciation and they see the success. Would you say that over the last 10 years, to me, I've seen so many different deals, and some people are doing great. Some people have developed systems and are truly successful, but there are mistakes that we made. Like, to be honest, like I've seen in my own portfolio, we've sold a couple of properties that are barely breaking even, and I feel like we're breaking even, we're lucky because thanks to the real estate boom rather than like my own success or my own decision making. I don't know if I'm explaining myself well enough. I think what I'm trying to say is that real estate, because of the asset class, it has been going up. And can we continue to can we operate smartly, and can we take advantage of the growth? Is what I'm trying to say, instead of relying on luck.
Yeah, and I think like I've got to say I am not a fan of pre-construction anything. I think that's more speculation than anything. But this is my own personal opinion, and everybody does it their own way. So however you want to do it, I prefer to buy an asset that is cash flow positive from day one and continue to manage it. And I think that you have to decide, and I'm saying that from my perspective, because I don't think it's wrong for people to do that. You just have to decide for yourself, why are you doing it? Like if you're doing it to pass on intergenerationally a condo to your kids, and you want to be able to do that, maybe that's a great asset. Or you're looking to add net worth, or you're just trying to make a quick buck. Like whatever your reason is, are you trying to create cash flow so you can quit your job? All of those things kind of push you into different assets, right? Like when I'm buying, I'm not buying, but if I were to buy a pre-construction, I'm betting that today's price that I'm locking into is going to be lower than the price that it's going to, when it's completed, is going to be sold at, right? And whether I take possession of that asset or not is, it's just going to depend on what I decide to do. Now, the tax consequence is going to be different depending on, whether you're holding that asset or not holding that asset, right?
Huge difference.
Right. And so that plays a part, but not everybody talks about that, right?
Oh, I try to. Trust me, I try to. Every other videos is about assignment HST and then assignment income, but people don't like to hear it.
Yeah, well, they don't like to, but that has to be part of the thought pattern of those people, and I like to buy assets that I'm going to hold on for the long term. I'm not looking to do quick flips, and I also think that sometimes those pre-construction condos are marketed as quick flips, right? And I just don't. It's just not me. That's my point of view. I think that, if you're buying that asset, it's cash flow neutral right now. I would say, how can you change the way that it's run right now in order to change the way that the cash flow comes from that asset? Do you need to go back to your tenants and say, listen, I don't think that this is I'm not making any money here. Maybe I can pay you, you know, a couple grand to leave, and you know, we can end the tenancy. Maybe I can do something else to make sure that cash flow is there in that asset. You know, I think we're only locked in because we think we're locked in, right? There may be other ways to go about doing this, and you know, thinking about the different ways that we can create cash flow from an asset to make it different is, you know, helps us to be able to hold on to that asset. Yep. So, you know, I understand what you're saying. The other thing too is like, you know, there are rules that we can take advantage of. For example, if you have a unit that's been created, I can't remember the date, is it like November 2018 or something like that?
Yeah.
If it's built after that,
Yep.
you're not in rent control in Ontario,
Yep.
for example. And that allows you to, like, if you're cash flow neutral, all of a sudden you bump up. Or if you built a basement suite from an unfinished space, that basement suite maybe is not under rent control, but the upper unit is.
Yeah.
But that basement unit can maybe make you cash flow positive in a way that allows you to hold on to that asset, right? So let's be creative. Let's think of ways to, like, I'm a total, you know, I like to think of different ways to be able to do things. There's not always one way, right? And
I like that. I like that a lot.
So like, let's, you know, what I would say is, okay, let's take a look at that asset and see what we can do with it in order to make it cash flow positive. There's lots of ways to do that.
That's amazing. Well, thank you so much. You've shared so much with us today, and I am very thankful to have you on our guest, like as my very first podcast host guest. So thank you so much. And for anyone who wants to reach out to you or find out more about Durham REI, how do they reach out to you?
You can go to durhamrei.ca, or if you want to reach out to me, I'll do a 15-minute call if you are the right criteria. If you go to quentindesouza.com.
Awesome.
And then we can chat and see if there's a good fit.
Yeah, awesome. Thank you so much for coming on again. Wealth of knowledge as always, and appreciate it.
No problem. Not at all. You did a great job too. It was awesome.
I just need to ask questions and add my text twist to it.
Yeah, that's it.
Yeah, awesome. Thank you.
Oh, you're welcome.
Thank you for watching. If you want to learn how to invest in real estate from scratch, my team teaches beginners how to use the #1 investment strategy that I personally use in a virtual free training class every month. Go to investortraining.ca/YouTube to register for our next class. The link is also in the description as well. I publish at least 2 to 3 videos a week here, so subscribe if you want to keep learning from seasoned investors like myself and my guests. And if you're just starting out, feel free to ask questions and comment below, and I do the best to answer each of those comments and questions myself. Again, if you're ready to learn the nitty-gritty about real estate investing from a professional investor, register for our next virtual class. That's at investortraining.ca/YouTube. Thanks again for watching. See you in the next video.